Lights buzz over a trading floor that never really sleeps. Computer screens glow with spot prices, derivatives, shipping manifests, and credit lines spanning continents. At first glance, it looks like a world powered by digital finance, bytes, bonds, and banknotes. But beneath all the noise, an ancient metal quietly drives the system. Gold. Not as jewelry, not as a hedge, but as collateral, the silent financial engine behind trillions in cross-border deals. To understand gold's power, you have to see beyond the bars. You have to imagine what they represent. Every ounce stored in a London, Zurich, or Singapore vault tells a story of credit, trust, and risk. For centuries, merchants needed assurance that promises would be kept across oceans. Paper alone wasn't enough, so they turned to gold, a universal guarantee that transcended borders, languages, and currencies. Today, even in the algorithmic age, the principle hasn't changed. When the stakes are high, the deal is sealed with metal. Picture a commodities trader in Dubai shipping copper to Shanghai. The cargo is worth $100 million, but to get it moving, the exporter needs credit. The bank isn't going to take just a promise, it needs security. Enter gold, a few thousand bars locked in an LBMA-accredited vault in London. Those bars, maybe 12.5 kilograms each, become the backbone of a trade finance facility. The bank issues a letter of credit against them, the cargo moves, the importer pays, and when the transaction closes, the gold is released. Nothing glitters publicly, but that quiet collateral just powered a deal across continents. In this world, gold is less a symbol of wealth and more a functional key. Unlike land or corporate stock, it isn't tied to a jurisdiction. It doesn't depend on government favor or company performance. It's liquid, portable, and instantly valued anywhere on Earth. That's why it remains the ultimate collateral for cross-border financing. Whether in London, Hong Kong, or New York, a bar stamped with refinery marks and serial numbers speaks the same financial language: trust. The mechanics are, honestly, pretty elegant. A borrower deposits physical gold, often those 400-ounce good delivery bars, into a secure vault. The bank then verifies the bars through the London Bullion Market Association's good delivery list and issues a credit facility, usually denominated in dollars. The loan-to-value ratio, well, it depends on market volatility, but it's typically somewhere between 70 to 85%. The borrower can use that cash for trade, hedging, or, acquisitions. If prices fall, margin calls are triggered, and if repayment fails, the bank will liquidate the gold. A sovereign fund might pledge bullion reserves to raise low-interest funding for infrastructure. A mining company might use future gold production as security for pre-export finance. In Africa and Latin America, bullion-backed credit lines have enabled governments to fund imports when traditional credit dries up. Gold bridges the gaps where politics and ratings fail. And while the gold may not physically move, the documentation does, rapidly and securely. Vault receipts, known as warehouse warrants, are digitally transferable under LBMA and COMEX systems. That means a trader in Singapore can pledge gold stored in London without touching it. Smart contracts and tokenization are now entering this space, allowing blockchain-verified collateralization. The Dubai Multi-Commodities Center and several fintech platforms have begun digitizing gold through tokens backed by real bars and approved vaults. That evolution adds speed, traceability, and fractional lending possibilities, turning ancient metal into programmable finance. Still, beneath the new tech lies the same old truth: trust must be backed by something tangible. Every electronic receipt still corresponds to a physical bar that can be weighed, assayed, and delivered. It's not the blockchain that gives the deal integrity, it's the gold. The economic impact is enormous. The World Gold Council estimates that over $2 trillion in global trade and finance references gold as an underlying asset each year. From letters of credit to derivatives to repo agreements, it's the invisible engine of liquidity. Gold-backed loans tend to have lower default rates and tighter spreads than unsecured facilities. For emerging market traders, pledging gold can cut financing costs by up to 3%. For banks, it's a balance sheet enhancer, an asset that meets Basel III capital requirements while diversifying risk. Of course, this golden engine needs maintenance. Volatility, storage costs, and regulatory scrutiny can dent its efficiency. When gold prices soar, borrowers face higher collateral requirements. When they drop, lenders grow cautious. Vault logistics, insurance, transport, security add friction. And there's an ethical question too. Does the global appetite for bullion-based finance indirectly fuel environmentally destructive mining? The LBMA's responsible sourcing program and blockchain-based traceability initiatives aim to ensure that the gold powering global credit is conflict-free. Even with these challenges, the system endures because it works. In a global economy fragmented by politics and currency blocks, gold remains neutral ground. A ton of gold is the same in Zurich as in Shanghai, in Riyadh as in New York. It doesn't care who rules, who defaults, or whose economy slows. That neutrality gives it unmatched utility in international finance, and it's not slowing down. As cross-border transactions expand with digital trade and resource shifts, gold's collateral role is deepening. In 2025, new financial structures are merging commodity trade finance with tokenized assets. Singapore, Dubai, and Hong Kong are developing integrated bullion finance platforms allowing instant collateralization of stored gold for trade credit. The result is, well, faster deals, lower risk, and a revival of gold's ancient role as the trust anchor of global commerce. It's kind of poetic, really. The same metal that once backed coins, then national currencies, now backs smart contracts and global trade flows. Across centuries, gold has been redefined, from coin to standard to collateral, and yet its function remains identical, to guarantee faith where paper alone just cannot. Walk into a modern vault and you'll find these quiet rows of bars, each worth hundreds of thousands of dollars, each tagged, audited, and insured. They don't move, but their signatures travel the world through digital ledgers, finance desks, and contract chains linking exporters and importers thousands of miles apart. It's here, in the hush of those vaults, that the machinery of cross-border finance hums the loudest. Because behind every billion-dollar shipment, every high-stakes trade, every handshake between banks separated by oceans, there is often a quiet constant: gold, the immutable witness to global trust. The next time a headline flashes about a massive trade deal between nations or corporations, just remember, somewhere, in a vault beneath London or Dubai, a few bars of metal are working harder than you think. They are not relics, they are engines. Old, silent, and honestly, indispensable. And that's the real story of gold as collateral. Not a glittering decoration, but the foundation stone of modern credit. A metal so old it predates civilization, and yet, so vital it still powers the future of global trade. If this story gave you a new lens on how money actually moves, hit like, subscribe, and stay tuned, because the next chapter reveals how those same bars are being reborn in the digital age, redefining trust once again for the markets of tomorrow.